Hi there, welcome to Kneppy Invest. Whenever I see a company I own move into a trading halt because of a potential capital raising, I do become a little bit nervous because, in my opinion, the majority of capital raisings aren't that good. Now, on occasion, I will come across a pretty good capital raising. In fact, in 2014 or 15, there was a company I own who went into a trading halt because of capital raising, and then I discovered that the capital raising was done at a premium to the share price, and that sort of capital raising is really unusual because the majority of capital raisings are done at a discount to the current share price, sometimes at a significant discount to the current share price. The other way I judge a capital raising is when that capital raising is done compared to the current share price level. Is the share price at historic highs or at historic lows? If the share price is at historic highs, that is the time to do a capital raising. That is the best situation for shareholders. You see this a lot with mining companies. Share price might rally 100, 200% on some good news, and then the company does a capital raising. That is a good capital raising, taking advantage of a significant share price appreciation. But sometimes you will see a company do a capital raising when the share price is at an all-time low. And these are absolutely horrible capital raisings because it is really dilutive for shareholders who have already seen the share price go through a significant depreciation. And this is absolutely true for a company called BWX. This company decided to do a capital raising on the 28th of June, and it was horrific for a couple of reasons. The first reason was it was done at a significant discount to the share price. And the second reason, the share price at that point in time was at historic lows. The share price had never been lower. So in this video today, I'm going to go through BWX, look at what the company does, and also look at why this capital raising was really bad. And the other reason I want to talk about this capital raising is I'm not even sure why the company is doing it. They have listed a couple of reasons. For instance, they want to shore up the balance sheet, also provide some working capital. But other than that, I'm not really sure why this company did this significant capital raising at a massive discount to the share price. BWX is a sort of a health and wellness company. They own a few brands, and to be fair with you, the only brand I know here that is owned by BWX is Circon, and many of these brands they have acquired over the past few years. So this is an acquisitive company, so they do make quite a few acquisitions. And a lot of times when you see a company make quite a few acquisitions, you have to realize that some of these acquisitions won't work. And unfortunately for BWX, to make these acquisitions, they have gone into debt and they have gone through some capital raisings. And in a way, I think if they just focused on Circon, which might be their original brand, because if they just focus on Circon, Circon seems to be doing really well. And I'm just judging by how ubiquitous Circon has become, the brand has become in supermarkets that I go to, when a few years ago I did not see a single Circon brand. So it seems like Circon is growing organically, and that is the best way to grow a company is by growing organically. Sometimes by growing through acquisitions can work, but it's way more risky. So in a way, I think if BWX just focused on Circon, they would be in a much better position than they find themselves in right now. Now, when it comes to the financials of BWX, nothing to really complain about. When you look at the revenue growth since 2016, in fact, revenue, and this is on a half-yearly basis, has grown from $26.8 million to $103.4 million. So revenue has been growing over the past 6 years, not in a straight line. There's a little bit of lumpiness there, but this is the growth I want to see when I look at the revenue for a company. Unfortunately, the revenue growth really hasn't translated to operating cash flow and free cash flow. So that's the other two things I'm looking at in this particular graph. Now, both of those, operating cash flow and free cash flow, have grown. But this company did see some problems in the most recent half year, even though they produced $103.4 million of revenue, they only saw $2.3 million of operating cash flow, and they actually had negative free cash flow of $12.6 million because they spent 15 point something million dollars on capital expenditure. So I would like to see that growth in revenue translate to growth in operating cash flow and also growth in free cash flow. Another thing I like to look at when I am researching a company is just how much debt they do have on their books, particularly these small cap companies. I do prefer companies like BWX to have as little debt as possible, because if they do have too much debt, they can find themselves in trouble in the future, which exactly is what has happened to BWX right now. So if you go back to last year, BWX had, and I'm looking at the balance sheet here, current liabilities and non-current liabilities, and financial liabilities is what I'm looking for in this particular balance sheet. In other companies, it can be called something else, but that is sort of the debt they do have on their books. And for BWX, that has grown from about $51–52 million last year to $84–85 million this year. Some of that increase in debt is probably because of acquisitions. So to fund these acquisitions, they have raised debt and also have completed some capital raisings. But I would like that debt levels to become lower. And one of the reasons they did do this significant capital raising at a discount was to decrease their debt. But when I do look at the specifics around this capital raising and how much it actually did lower debt, I'm just thinking, why the hell did they bother? Now, before we have a look at the specifics of the capital raising that they released on the 28th of June, just want to go back to the 5th of May, because within the capital raising announcement, they also gave a trading update and also gave some guidance, financial guidance for financial year 22, which they updated from May of this year. And also they gave their first guidance for financial year 23, which I do find interesting. I'm not sure how they came up with their projections for financial year 23 because of the amount of uncertainty in the economies, or the economy of Australia and also overseas as well. But if we go back to 5th of May, this is when they did give some guidance for financial year 22. The market actually didn't react well to this. In fact, the share price did decrease by a significant amount. They did expect revenue to grow from last year from 194 million to between 233, 243. Ignoring the underlying revenue and also ignoring the underlying EBITDA, just focusing on the real numbers here. Unfortunately, even though revenue did grow between about 20 and 25% from last year, EBITDA was expected to go down from last year between 10 and 19%, from 33.4 million to 27 to $30 million. Now to the specifics of this particular capital raising. There were two parts to it: a $13.5 million placement to sophisticated and professional investors, and also a $9.7 million 1-for-10 traditional non-renounceable entitlement offer for current shareholders. Now, it's good to see current shareholders get a piece of the pie. I would have preferred current shareholders to get a bigger piece of the pie than the sophisticated and professional investors, but sometimes current shareholders are completely left out of these sort of capital raising. So at least they got a piece of the pie, but I would have preferred them to get a bigger piece of the pie. Now to the reason why, or one of the reasons why I think this was an absolutely horrible capital raising, that is the discount to the last closing price before the company went to a trading halt, a 48.7% discount. So this particular capital raising was done at a share price of 60 cents. So I'm not sure why they needed to do such a significant discount, because you just know, as soon as I saw this announcement, I just knew the share price was going to it'll take an absolute hammering and actually move towards that share price of 60 cents. So no wonder shareholders of this company were absolutely upset with this particular capital raising done by the company. And it's also quite dilutive. So they're raising $38.6 million new ordinary shares. So that's a 24%, that represents 24% of the current ordinary shares on issue for BWX. So this was a dilutive capital raising. And as I went further and looked at the reasons behind this capital raising, I just didn't understand why they had to do this specific capital raising. I'll get into that during the rest of this video. The other thing I did in this capital raising announcement was to give a trading update and some guidance for financial year 22. Even though financial year 22 is almost coming to an end, they had to upgrade the guidance, and it was a significant downgrade to their previous guidance. And some of the reasons why they've really decreased the guidance for financial year 22 is because of challenging conditions in the retail sector. So they're blaming increasing inflation, interest rates increases, and more cautious consumer. So even though there are some people out there saying the economy right now is really strong because of high inflation, we are seeing decreasing spending by consumers, even though the May figures have just come out. But there are a few companies who are releasing announcements saying they are starting to see some trouble in the economy. So even though there are these experts saying really strong economy because of really low unemployment, when you look at the bigger picture, the economy of Australia and the rest of the world is not really strong at this point in time. And that's why BWX had to give a downgrade to their guidance. And it was a fairly big downgrade. So I've just compared to their May guidance on the far right to the guidance now. So the decreased revenue or expected revenue from a range of between 233 and 243 to 206, that is a significant decrease to their original guidance, more than 10% decrease, almost 15% decrease. And EBITDA, instead of being or expected to be between 27 and 30 million, now is only expected to be between 6 and 10 million. They also gave some guidance for profit, and they are expected to be loss making between 10 and 14 million dollars for this particular financial year. And this was a significant downgrade. Another reason why the share price took a massive hit when they made this announcement to the market. Another thing they did was actually provided some financial year 23 guidance, and they're expecting some significant growth when it comes to revenue and EBITDA. But I don't know if I can actually believe their guidance right now, simply because the uncertainty in the economies around the world, including Australia. And also, I think the trust we have in management should be broken right now. So we can't really believe any guidance they have given us for financial year 23. And I think the market agrees with my sentiments right now. So I'm not going to really focus on that financial year 23 guidance. But if they do hit that financial year 23 guidance, the valuation of this company right now does look really cheap. But I think the potential of them hitting that guidance is really low. So why did they do this particular capital raising? It was all about shoring up the balance sheet by decreasing debt. And this was a particular slide in their presentation. So they talked about the net debt right now, which is right on 82 million. And the proceeds of this capital raising, 22 million, will lower that debt to $60 million. And right there, I'm thinking, why bother? You're only decreasing debt from 82 to $60 million. And then based off their financial year 23 guidance, they're expecting $52 million in operating cash flow to decrease that debt to 8. They also talked about decreasing inventory, which means the debt levels would be almost zero. And then you add on taxes paid 8 million, capital expenditure 10 million, and other 9 million, which means they are expecting debt at the end of financial year 23 to be only $23 million. So I'm not really sure how this capital raising helps their debt levels, even though it does decrease it by 22 million. It just seems really insignificant, really unnecessary. Why they had to do a significant discount to the current share price just to decrease their debt levels from 82 million to 60 million when they expect a really good financial year 23 and the debt decrease from 60 million to 23 million. It just seems really unnecessary. So I think there must be some other reasons. Maybe they were forced to do this capital raising because business is just so bad right now. They are afraid that things might turn really bad and they might find themselves in financial trouble if they don't do this capital raising. Maybe the debt holders force them to do this capital raising for some reason. I think there has to be some other reason why they did this capital raising, because the specifics of the capital raising, the debt decrease of the capital raising just looks, why bother? That's the biggest question I have right now when it comes to this particular capital raising is why bother? And the market reacted exactly as you thought they would react. So with a 48% discount to the current share price, the share price was going to take a massive tumble, particularly with the changing guidance for financial year 22. So even though they provided financial year 23 guidance, and I think they provided that just so the share price wouldn't take an absolute hammering, I'm not sure that really helped because I don't think the market absolutely believes their financial year 23 guidance. So overall, the share price of BWX fell from $1.17 to 69.5 cents, which is a 41% drop. It wouldn't be surprising to see the share price drift down towards 60 cents over the next few weeks. In fact, today, on the 29th of June, I am recording this video at about 2:30 p.m. The share price has dropped another 2 to 3%. So the share price looks like it might be drifting down to those levels. So this is an all-time low in the share price. In fact, the share price was at an all-time low at $1.17. So again, the worst time to do a capital raising is when the share price is at historic lows. Now onto the chart for BWX. This is the daily chart going back to about May of last year. So about 1 year chart. And if we go back to the middle of 2021, the share price of BWX actually did reach a high of about $5.50. And you can just see how the share price has completely fallen off a cliff over the past few months. The company has released some negative news to the market. That's why we have seen some big one-day drops in the share price. And that has really triggered a downtrend in the share price, really triggered some negative sentiment when it came to this business. And the dash line I have at about $1.30 was the all-time low we saw about 3 or 4 years ago, and the share price has fallen significantly below that all-time low. And right now, at about 69 cents, the share price is almost half of what it was at an all-time low about 3 or 4 years ago. And when the share price did reach that all-time low about 3 or 4 years ago, I still remember a lot of people got excited because they saw some value in this company, and they probably did do fairly well if they bought in at the all-time low and then sold when the share price reached about $5. But this is or has not been a company you want to own for the long term, just because of the violent volatility in the share price movement since they listed on the market about 6 or 7 years ago. That's it for this particular video on BWX's absolutely horrible capital raising. And the reason I define this capital raising as horrible is because of 2 reasons. The significant discount to the share price, a 48% discount to the share price, and that would be traumatic to current shareholders who've already seen that capital absolutely being hammered over the past few months, let's say the past 9 months or so, with the share price falling from $5.50 to $1.17. So this would have been absolutely traumatic for current shareholders. And the other reason I would define this as a horrible capital raising is because the capital raising was done when the share price was at an all-time low. You want to do capital raisings when the share price is at an all-time high. So if you do have any opinions about this particular capital raising, this particular company, if you disagree with any of my thoughts, I'd love to hear what your thoughts are, because that is how I grow as an investor, taking on board different opinions. So leave that in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.